Good evening and welcome to our 2024 second quarter financial market update from Great Lakes Private Wealth. This is Dan Murphy, founder and chief investment officer of Great Lakes Private Wealth. I've titled tonight's call, The Great Rotation. The call tonight is being recorded and will be on our website, greatlakesprivatewealth.com, shortly afterwards. Now let's get into what happened in the market in the second quarter and what we see going forward. Pat Patin will give us some data, and then I'll update you with my outlook on the markets. Take it away, Pat.
Thank you, Dan. This is Pat Patin, partner and portfolio manager of Great Lakes Private Wealth. Before I get started, I must remind everyone that past performance is no guarantee of future results, and all the information we will be providing is from sources we believe to be reliable, but there's no assurance that the information is accurate or complete. Starting off with some key stats for our call, the year-to-date price return for the S&P 500 through tonight is up 14%. The Dow Jones Industrial Average is up 8.1%. The Russell 2000, the small cap index, is up 10.7%. The NASDAQ Composite Tech stocks are up 14.2%. International stocks represented by the EFA index are up 4.6%. Gold is up 16.4%. And bonds represented by the Bloomberg Aggregate Bond Index total return are up 1%. What a news cycle we've had over the last month. A Supreme Court ruling on presidential immunity, several surprise foreign elections, a presidential debate, a major hurricane, former President Trump's assassination attempt, and an unprecedented exit from the presidential race by President Biden, and the largest software outage in history. That was just a portion of what happened, and yet the financial markets are unfazed. It's during these events that we are reminded why it remains critical for our team to continue our investment process that has been cultivated over decades of experience through these major market, economic, and market cycles. We follow a disciplined approach with an intense focus on our systematic models and adherence to this discipline forged over 30 years in the investment industry across numerous market cycles. Our unique approach to asset allocation offers a better way for many investors. We have the agility and the flexibility to make sudden adjustments in changing environments that we feel are second to none. We spend a substantial amount of money on research each year to stay at the forefront of the investing world. This allows us to adapt rapidly, and as legendary hockey player Wayne Gretzky says, skate to where the puck is going to be, not where it has been. We are thrilled with our results so far this year, and if you listen to our last quarterly call, we nailed the big shift in outperformance from the large cap tech companies to small companies that has really become apparent over the last few weeks. On our last call, we made 4 big forecasts that were non-consensus last quarter that have thus far proven correct. 1, that inflation would continue to stabilize. 2, that interest rates would remain stable and then start to go down with a Fed rate cut in the fall. 3, that the economy was slowing but not heading into a recession. And 4, that small cap stocks would start to outperform with this environment backdrop. The proof is in the pudding, as they say, and this has led to a stock market near all-time highs, with the last push coming from small cap companies for the first time in years. As I mentioned earlier, we continue to be able to adjust to changes in market environments quickly, and that puts us in a unique position in this industry to help our clients. And now, I'll turn it over to Dan, and he'll give his market outlook and our updated forecast for the coming months. Dan?
Well, thank you, Pat, and good evening, everyone. The second quarter proved to be another very good quarter for our clients. The S&P 500 stock market return for the first 6 months is one of the best starts to a year since 2019. It's also one of the best starts to a presidential election year in the history of the market. Again, it's hard for most investors to understand how the market can do so well in the face of such crazy global macro issues such as war in the Middle East between Russia and Ukraine, the war in the Middle East, and then to top that off, think about the political backdrop in the United States with the impending presidential election this November. The events that have taken place just in the last 30 days, as Pat mentioned, the debate between President Biden and former President Trump on the June 27th. Then just 2 weeks later, on July 13th, an assassination attempt on former President Trump. Then 8 days later, on July 21st, President Biden decides to withdraw from the race for president, and he turns the baton over to Vice President Kamala Harris. If someone had asked you to predict how the market was going to do over the next 30 days with that news backdrop, no one would have predicted a 4% increase in the Dow Jones average or a flat S&P 500. But that is exactly what happened. This leads me to explain why tonight I called this call the Great Rotation. In the last 30 days, we've had what I consider some major changes to the economic outlook going forward. And this in turn will affect what stocks take over and become the new leaders in the stock market for the balance of 2024. Let me explain why. For the first part of 2024, we had stock market indexes that were being pushed higher due to just a few individual stocks. These stocks are now referred to as the Magnificent Seven. Everyone knows these names: Apple, Amazon, Google, Facebook, now Meta, Microsoft, Nvidia, and Tesla. The S&P was up 14.5% for the first 6 months. If you took those 7 stocks out, the Mag 7, the S&P 500 would have been up only 6%. These 7 stocks recently accounted for 31% of the value of the S&P 500. This is just too much concentration in just 7 stocks. Since June 30th, the Mag 7 stocks are down in value 4%. The Dow Jones Industrial Average is up 4%, and the Russell 2000 Small Cap Index is up 9.5%. This is the Great Rotation I'm referring to. The Magnificent Seven are overowned by institutions and many smaller investors. The Dow Jones stocks, the old brick and mortar names, are underowned. This includes the small caps to a large extent as well. If you remember from my call in April, I predicted this was going to happen. I thought it would occur in May or June, but it happened in July. And when it did, it happened with a bang. The Russell 2000 has gone up 9.5% in July, whereas the S&P 500 is unchanged. The NASDAQ Composite is down 3.3%, and the Mag 7 stocks are down over 4% for July. This net difference between the Mag 7 and the Russell 2000 is 13.5%. The question now is, will these small cap stocks continue to outperform, or will the large cap stocks take back the leadership of the market? Before I give you my outlook on that, let's look at the key drivers of the stock market. The key drivers historically of the market have been inflation, interest rates, stock market sentiment, and, very importantly, corporate earnings. The key inflation report, the CPI, or Consumer Price Index, came out in July on the 11th, and it was reported down 0.1% month over month. This was a surprise, and it created the first positive reaction for the small cap stock universe. One of the main indicators the Federal Reserve uses to measure inflation is called the PCE. This stands for Personal Consumption Expenditures Index. On July 26th, the PCE came out at up 0.1% month over month, and the year-over-year annual rate was 2.5%. This is very positive since the Fed has stated they want to see inflation closer to their 2% annualized target before they start lowering interest rates. There are several other factors that are going in the right direction for the Federal Reserve. Oil prices have stayed quite low, mainly due to the softening in the Chinese economy, which has reduced the demand for oil on a global basis. This helps keep inflation lower. Another factor is agricultural prices or food inputs like wheat and corn have declined in price this year. Corn is down 26% year on year. Wheat is down 26% year on year. Sugar is down 24%, and steel is down 18%. This data we get from Trading Economics Incorporated. So in general, the pressure of higher prices is finally abating, which will give the Federal Reserve room to lower interest rates. Now, lower inflation is just one element the Federal Reserve has stated they'd like to see before they begin to lower interest rates. The other key indicator is the unemployment rate. They would like to see the tightness in the labor market abate and see the unemployment rate go up, which in turn would allow them to lower rates. Conversely, though, if inflation were to reaccelerate or the job market were to get tighter, I believe it would force the Federal Reserve to raise interest rates even further, and this in turn would lead to a substantial sell-off in stocks. I want to be clear, though, I do not see the Federal Reserve being forced to raise interest rates at this time. Now, could the outlook change later in the year? Of course it could. At Great Lakes Private Wealth, if the data and conditions change, we change. The Federal Reserve wants to be sure that inflation is under control and the economy is stable. Remember the analogy I used back in April, and I said they need to turn the heat down on the pressure cooker of the economy without turning the heat off completely and causing a recession at the same time. Well, as of today, I believe they've accomplished this. Last month's unemployment report was released on July the 8th, and we saw the unemployment rate tick up to 4.1%. This is the highest level since 2020, and average hourly earnings increased at 0.3% month over month and annualized at 3.9%. This was the slowest pace since June of 2021. Higher unemployment and lower wage inflation is what the Federal Reserve is looking for. So everything is going in the Federal Reserve's favor right now. There's always a risk that they waited too long to lower rates and we end up having a recession. But as of right now, it appears they've walked the tightrope and will accomplish their goal of slowing inflation and slowing the economy just the right amount to allow them to lower interest rates. If you remember in my call in January, I said I thought the Federal Reserve would lower rates only 1 or 2 times this year, 2024. My opinion was in the minority at the time, but now has become the majority opinion. As far as a recession goes, I do not think we'll have one in the near term. Yes, the economy is slowing at a very measured pace, but it is still growing and creating new jobs. If they do not lower rates over the next 6 months, then a recession is very possible. So, where do I think rates are going and when? The Federal Reserve is meeting today and tomorrow, and they could lower rates at this meeting, but that would be highly unusual since they like to telegraph their plans weeks ahead of time, and there has been no indication that they will do that tomorrow. What they will do, I believe, is tell us the data has improved and the data is supportive of making a cut in interest rates in the very near future. This will lead to a cut in rates at their September meeting of the Federal Reserve. I believe they will also lower again at the November meeting, which is the day after the presidential election on November the 5th. Now, any further rate cuts will be all tied to the level of inflation and the unemployment rate. The Federal Reserve likes to say over and over they are data dependent. This means if the data gets weaker, they'll lower rates further. If data gets stronger, they will not. So bottom line, we're entering a lowering cycle for interest rates for the first time since March 16th, 2020. This is a very positive development for common stocks going forward. If we look at how stocks, bonds, T-bills, and inflation have done over a long period of time, stocks still represent the best hedge against inflation over the long term. Since 1926, inflation's averaged around 3%. Treasury bills have returned about 3.3%, and bonds have returned 5.1%. But the best performing asset class over this time continues to be common stocks with a return of 10.4% since 1926. This data is from Ibbotson and Associates. If interest rates are about to start falling, where's the best place to invest and take advantage of falling interest rates? Well, bonds for the first time in over 4 years represent an opportunity. In many of our portfolios, we sold long-term treasury bonds represented by the iShares ETF called TLT in March of 2020, and we sold those bonds near the low in interest rates. TLT at the time was selling for $150 a share. Today, TLT is trading near 93. That's a drop of 38% over the last 4 years. This is a perfect example of what happens to bond prices when interest rates go up. The big news is, for the first time in 4 years, we're positive on investing in the bond market. Now, let's look at how equities do, though, when interest rates are in a falling cycle or a falling environment. In this cycle, smaller companies typically do much better in a falling interest rate environment because, well, smaller companies tend to borrow money, and when rates go up, those smaller companies get hurt by the higher interest they have to pay. When rates go down, it makes them more profitable because, again, they have less interest to pay on their debt. The other factor that helps smaller companies is that if interest rates are falling, it usually leads to the economy improving over the next 6 to 12 months. So that is a bonus as well to these smaller companies. From July the 16th through July 26th, the small cap index rallied over 10% in just 5 trading days. We call that a price thrust. Since 1987, whenever the small caps have shown that much strength over a short period of time, the average 1-year return 1 year later is up 23.1% and is up 91% of the time. These are very impressive numbers. There's still a lot of skepticism that small caps will outperform the big cap mega cap names. The 2 big reasons are, is this a trend towards falling rates, or is it a one-time drop in rates? The other major benefit, though, that the mega cap tech names have in their favor is they're sitting on massive piles of cash in the bank, and many of them have almost no debt. They're all buying back their common stock. The reason for everyone being so skeptical is they've been expecting interest rate cuts for 6 months from the Federal Reserve, yet the Federal Reserve has not obliged with lower interest rates. So there will be a lot of discussion going forward on where to place your bets. Is it on the large caps who have been the winners all year, or will it be on the small caps who do well in a falling interest rate environment? The jury is out until we officially have had a cut in rates. Because the performance of the Magnificent Seven has been so good, most of the public's investment dollars have been in the Mag 7 stocks. Money managers' dollars have been going into the big stocks as well. As a money manager, if you didn't invest in those big stocks, you probably underperformed the indexes so far this year. Remember, I said earlier in the call that if you didn't own the Mag 7 stocks for the first 6 months of this year, the S&P results without those stocks returned only 6%. From July 16th through today, the Russell 2000 is down 1%. The S&P is down 4%, and the NASDAQ is down 7.4%. So we finally started to see outperformance by the small cap names. Here are a couple crazy statistics. The Mag 7 stocks' combined market value is higher than any non-U.S. stock market in the world. These 7 stocks on their own are worth more than the entire stock markets of all other countries. They're almost double the value of the whole Chinese stock market. They're worth more than the markets of Germany, Canada, United Kingdom, France, and the Indian stock markets combined. The U.S. stock market is valued at around $50 trillion. The Mag 7 as a group are worth around $15.7 trillion. This data is provided by Bloomberg. This is the largest concentration of the top 10 S&P 500 stocks since 1972. In the 1970s, these stocks were called the Nifty 50. Today, it's the Mag 7s. As of July 30th, they accounted for 31% of the value of the S&P 500. This overconcentration cannot last much longer, and it actually may have started to get reduced with the outperformance of the small cap and mid cap stocks in the last couple of weeks. Well, let's talk about investor sentiment. I've stressed over and over how important it is that, especially when deciding to put our assets to work. Up until a week ago, we had not had a single day sell-off of 2% in the market in over 356 trading days. This is the longest streak since 2007. Well, on July 24th, we had it. It was the biggest drop since December of 2022. That quick but big drop in the Mag 7 has gotten sentiment back to a very neutral, if not slightly negative point. You've heard me say over and over, when everyone else gets negative, we get positive. When everyone else gets too positive, we get negative. So as of today, the CNN Fear and Greed sentiment is at 40, which is in the neutral zone. Our Ned Davis Research daily sentiment reading is also in the neutral zone as well. So this sell-off in the Mag 7 and high-tech names has really helped us get into the neutral zone when it comes to investor sentiment. I'd like to share some other factors that we're watching just to make sure we don't miss something in the economy that could be a warning to us that something more serious is happening within the U.S. economy. To give you an idea of the toll that higher interest rates have had on companies, in the first half of 2024, there were 346 companies that declared bankruptcy. That was the highest number since 2010. In June alone, 75 companies filed for bankruptcy. That was the highest monthly total since 2020. This data, again, comes from Bloomberg. U.S. credit card delinquency rates increased to 3.16% during the first quarter. Now, that is less than the pre-financial crisis average of 4.41 from 1991 to 2007. But they have actually risen for 10 straight quarters in a row and are now the highest since the fourth quarter of 2011. Another indicator to watch is the Conference Board's Index of Leading Economic Indicators. It has been flat or lower for 28 months through June of this year. The only other two streaks to last more than 20 months was March of 1975 and March of 2009. Now, this may seem negative, but it is actually very positive. The one-year gain after the occurrence in 1975 was a gain in the S&P 500 of 20.9%. The gain after the March 2009 occurrence, 1 year later, the S&P had risen by 57%. Now, you have to remember, both of these were periods where we had had substantial declines in the market during the previous 12 months. Today, we are very close to all-time highs. But again, I believe we're on the verge of a lower interest rate environment. The main reason we're at new highs, though, is the Mag 7 stocks. Now let's talk about the election that will occur in November the 5th. Bespoke Research looked back at the last six presidential elections in the last 25 years and found the market returned 0.05% over the next 3 months. 2 times we had big gains, 2012 and 2020, and 2 times we had big losses in 2000 and 2009. In presidential election years where the market was up significantly, like we are today, the next 3 months were still slightly negative at best. Now, whenever the market was up over 10% in an election year, the average decline was 1.5% over the next 3 months. So nothing too dramatic, but nonetheless lower. Why? The market hates uncertainty, and in this presidential election, we sure have it. My next call will be the week before the election, so that will be an interesting call for sure. Now, as Pat said, we've had a very good year so far. The big question now is, does a strong start to the year predict anything about the future? Well, let me give you some statistics. Whenever the S&P 500 has gained between 13 and 17% in the first half of an election, in a year of an election, the second half of the year has always been positive. The worst return was the presidential election in 1976 when it was up 3%. Now let's look at how the market is done when it started off so strongly like it has this year. The S&P was up 14.6% in the first half of this year. Historically, since 1950, whenever the S&P is up over 14% in the first half, the average return for the second half is up over 9% and is positive 80% of the time. So in general, the data is in our favor, election year or no election year. Another stat I saw was, how has the market done over the last 7 years? Before I tell you the results, think about what we've lived through the last 7 years. We had a very contentious elections, division among voters. We experienced a global lockdown due to COVID, Russia, Ukraine, Israel, Hamas at war, and now again, another contentious election. The stock market, as measured by the Dow Jones Industrial Average, has gone from 20,000 to 40,000. Would anyone have ever guessed that would be possible? I said earlier, the best asset class since 1926 is common stocks with a return of 10.4% annually. Remember I said the title of tonight's call, The Great Rotation. I want to share some additional stats about the potential returns for the market over the coming 6 to 12 months. Recently, the small cap stocks outperformed the large cap stocks by over 5% over a 5-day period. Whenever that's occurred, 1 year later, 8 out of 10 times, the S&P was higher on average by 17%. This data comes from Carson Research. Now, why do I like the smaller cap names now versus the bigger cap names? The small caps just had one of their best rallies ever over a 5-day period. It was up over 11.5%. That's right, 11.5% in 5 days. Carson Research found that since 1979, this has occurred 10 other times. And 8 of those times, the market was up. The average return for the small cap index was 25.4% 1 year later. This supports my belief we're on the verge of a great rotation of the small caps outperforming the large cap stocks. So let me summarize what I've stated tonight. First, we're going to see the first drop in the Federal Reserve's overnight lending rate in over 4 years. If this occurs, as I expect, then smaller names will do better than bigger names. Secondly, we're seeing the economy starting to slow, and that will support lower interest rates as well. Third, inflation is finally retreating. which again will be supportive of lower interest rates. When you take this backdrop of factors, low inflation, slowing economy, lower interest rates, if history is any guide, then we should be looking at the small and mid-cap stocks going forward, as they represent better values than many of the mega-cap names that are frankly overpriced and overowned. Now, this doesn't mean the large-cap mega techs won't go up, but the outperformance we've seen, I believe, is over for now. If rates drift lower and the economy slows just slightly, you're going to start to hear the media say we have the possibility of a Goldilocks economy, or you may even hear the term, we've achieved a soft landing for the economy. I believe based on the data we have at the moment, a soft landing is very possible. That would be very bullish for stocks going forward. As far as the election goes, no one can predict that. As far as the war between Russia and Ukraine or the Israel and Hamas, when those will end, no one can predict. So we have to invest based on what we know and see is actually happening in the economy. And as I said, the first drop in rates in 4 years is coming. Inflation is moderating and slightly falling. The U.S. economy is the best economy in the world. Take all that into account, and our outlook is positive. Now, it's been just over 1 year since I started Great Lakes Private Wealth. It's been an amazing journey, and I'm extremely proud of what we've accomplished in such a short period of time. So I want to say thank you to my team, and I especially want to thank you, our clients, for your loyalty and for joining us on this incredible journey. We greatly appreciate you. You have my promise that everyone at Great Lakes Private Wealth will do everything in our power to continue to earn your trust every day. I want to thank you for listening, and I wish you a very safe and enjoyable summer.
This presentation is for informational purposes only and is not an offer or solicitation to purchase or sell any security or to employ a specific investment strategy. It is not designed for or individually tailored to any particular investor and is not intended to be suitable or in the best interest of all types of investors. This information should not be relied upon as research or investment advice and is strictly illustrative, educational, or informational purposes. Opinions expressed in this presentation are subject to change without notice. There is no guarantee that any forecast will be realized. Commodities, including precious metals, carry substantial risks and have experienced periods of extreme volatility. Investments in commodities may be affected by changes in overall market movement, commodity index volatility, changes in interest rates, or other factors affecting a particular industry or commodity. Past performance is not a guarantee of future results. Investing involves risks, including the possible loss of principal. Index performance is for illustrative purposes only and does not include dividends otherwise noted. Index are unmanaged, do not incur management fees, costs, and expenses, and cannot be invested in directly. Data contained herein from third-party providers is obtained from what are considered reliable sources. However, its accuracy, completeness, and reliability cannot be guaranteed. Data is as of the date noted and subject to change. Investment advisory and financial planning services offered through Summit Financial LLC, a SEC-registered investment advisor, doing business as Great Lakes Private Wealth. Summit Financial LLC does not provide tax or legal advice. If you require such advice, you should contact the appropriate tax or legal advisor. Have a good night. Thank you.